Hello, hello. You are in my kitchen. It is nighttime here, so I have the fun LED lights back there under my cabinets, and wanted to do a quick video for you on what I would consider a pretty solid ETF portfolio. Now, of course, there are going to be tons and tons of opportunities and options that you can choose from to create a nice foundation for a long-term portfolio or um, an ETF conglomerate portfolio if you wanted to choose something more on the lines of touching into a whole bunch of different stocks that are not individualized. Okay, that's what ETFs are. They're exchange traded funds. So they're going to be a whole bunch into one. Now, those of us in the Discord, we all know this pretty much. And the one thing that I know those people on Discord, the members there, and if you've been watching my videos, you definitely understand that I love high dividend stocks or ETFs. I feel like if you're going to have some growth, you might as well get something else with it if there's an opportunity for so. And so these five ETFs I feel like are going to be a solid choice. And as you can see on the screen, with of course the stock analysis website that I absolutely love, you can see that we have one, two, three, and only four. The fifth one is in a whole different tab, and I'll cover that one in a second. So the first one is going to be VIG, which is Vanguard Dividend Appreciation ETF. That one has a return of 1.7 at $207 a share at recording. These are going to be at recordings. Okay, so around 207 per share at 1.7. This one touches on the S&P dividend growers index. So any of the high growth stocks, this one's going to grab, and large cap indexes basically is what this one's going for. So the idea of what we're going to try to find in different ETFs here is a conglomerate grouping or index of various parts of the market, so that when you have some that go up, like tech rising, but real estate or consumables going down, you have a nice flow. This way you don't have everything all in one basket. Of course, that's what diversification is supposed to be about. So VIG, that's going to be the blue, the light blue there. FDVV, which is the Fidelity High Yield Account. Stock, I always say account. I don't know why I do that. Stock, FDVV. So that one's going to be the orange. That one you can see did quite well in the last 5 years. That is a 3.3 return at a $53 stock price. The whole point of this one is large and mid cap, along with high dividend companies. So they're going to be high dividend companies within the large and mid cap range of the stock market in a whole. So I've got a few examples here that is inside of this fund: Apple, Microsoft, Nvidia, JP Morgan Chase, Visa, Exxon, Philip Morris, and Procter and Gamble. So you have a nice flow through all of those, and there's a lot more. I think there's like 60 or 70 in that fund that they track at a 3.3 return. Now, all five of these are going to, well, I'll say all four of these are going to be a low expense percent. Now if you're moving some serious funds around, you want to be careful of that, because you're going to be paying these, trade active managers to run your portfolio via these ETFs. So be aware of that. All of these are going to be quite low. I believe they were like less than 0.1. But they can change. So make sure you do your due diligence as we go. Next one is HDV, and that's going to be that darker blue, indigo, purpley color. And that's again at 3.3, but $120 a share. This is iShares Core High Dividend Index. And this is the one that follows, again, high dividend companies, around 75 total stock average within that fund. through iShares. Okay. The next one is SPYD, which is a Spider S&P 500 basically. It tracks at 5% interest rate, $44 a share. And this is going to go with the S&P 500, but with less volatility. And of course, price point is at $44 versus S&P, what today? I think it broke, what was it, 617? No, 627, something like that. It broke today. So clearly a lot more affordable. You can grab many more shares of this for the same price as you could get one of the S&P 500. And you don't get the crazy volatility that you'll have with the S&P on a major downturn. So those four, let's see, S&PD was the green. So for the last 5 years, as you can see here, we're looking at some pretty nice numbers. Now this dip here is the April Liberation Day, right? We all know this one all too well. Beyond COVID style days, this one was probably one of the biggest hits we've had, but a quick turnaround. So if you held your shares through all of that, maybe added some, you fared quite well, and most of the stocks rebounded very, very nicely from it. So, anyways, these four ETFs could, if you wanted to dabble in an equal amount of money, say like 1,000 each, so you put 4,000 in, you spread it across the board, you're going to have some, like, well, we'll put the cursor on most current here. Let's go over to the 1 month. Okay. The most current, you're going to have FDVV at 53, HDV at 120, SPYD at 43, 44, and VIG at 207. So VIG is going to be your most expensive stock. So $1,000 in VIG will not go as far, obviously, as it would with SPYD or FDVV. Okay, that's just basic math. I know I don't want to insult any of you here. I know you understand that, but if you were to look at the total track for the year, we're very close. And this year's been tough. This year's been tough because we came into from the summer into elections. This is earnings season right here, into elections right there, inauguration, and then we had Liberation Day, and we've had tariff issues since then. But year to date, let's see, we've got HDV leading the way and FDVV second. But our whole point of creating this portfolio base is to have a long-term hold, right? Where you use high dividend payments to reinvest into the funds and compound our returns. So you'd have to go to Google and actually look at each one of the returns. I did have some. I didn't write down the dividend percent. I don't have the percents, not the payments. But look those up. They're going to be quite nice in comparison to, like Nvidia or others that are like 1.3 to 1.9, 2.3, something like that. And then of course you have the crazy swings that come with individual stocks, unlike the ETFs, which are much more stable and safe. You look at the 10-year. If you were to start this 10 years ago, look at this. Here's your COVID. But we have really nice gains if you were to start these funds back in 2016. And then maybe if you added some more shares at the bottom here of 2020, because it basically cut you right back down to your 2016 prices. You added the bottom of COVID time. We ran up 220% for VIG. And then FDVV, we ran up almost 200%, 135, 126. Now, granted, it's 10 years. Okay, 10 years is a long time. I fully understand that. But the whole point of doing something like this is to look at the long-term gains of these ETFs. There are, like I said, there are many ETFs out there that are solid that reflect a lot of these, but these ones pay a bit more in the dividend side of things, with also not having to overpay on your expenses. There's a lot of dividend stocks like MSTY that pay very high dividends. GLDI, same thing. many of the yield max, but their expense ratios are much higher. So you're going to be paying a lot more fees to get those higher dividends. And sometimes you don't get a high growth like you would here. So I mean, you could always cut out the higher priced ones, like we could take out VIG, go with just HDV and the rest. We could do that. Cut out what did I say? Sorry, VIG. We'll cut this one, though I like that one a lot. We cut that one. It gives us a bit more clear 5-year span. So FDVV is the Fidelity High Yield stock at 3.3%, $53, large and mid cap. So you have a lot of tech and you have a lot of consumables. You have a lot of diversification within the FDVV. The SPYD obviously follows SPY, just more of a lesser deal. Now, I told you about the fifth one. We'll go over there real quick. I have both of them in here because I wanted to show you what this looks like. JEPQ and JEPI, or JEPI, whatever you want to say, is ones that I find curious because though JEPQ is newer, I think if you look at this chart, if you bring the angle of incline up and match it, overlay the orange, which is the JEPI or JEPI, I think you would have beaten it in the slope. And if we give it more time, there's a chance with the really strong market and economy coming up here, there is a chance that JEPQ will actually overtake JEPI. Now, I do have some notes here that I can read real quick to you. Even though JEPQ has 11% monthly dividend return, which is sweet, it does have more volatility. And that volatility is what you see here. It does not have as much gain in the growth as JEPI does. JEPI follows the SP 500, but with ELNs, which is equity linked notes. That's a complex situation I'll cover just in a second. They tend to try to keep the volatility down. As you can see in the orange, it doesn't have massive swings outside of the Liberation Day, but even then, it wasn't as bad as JEPQ had taken in. So the reason of JEPI is nice is though it only pays an 8.3% monthly return, it does not have a huge, as much of a volatility swing as JEPQ does. So if you're looking for a return of a decent monthly dividend, which is 8.3%, it's between 35 cents and 50 cents. It does vary. JEPI would be a very nice stable fifth ETF for your portfolio. If you want a bit more volatility that you want to DCA in on those dips and have more opportunity to DCA on dips, well, obviously JEPQ is going to be your winner. And like you look at this chart, I think if you were to shift that line up higher, I believe that we would actually have overcome on the slope of JEPI. So there's your two. Oh, sorry, JEPQ is large cap and they follow NASDAQ 100. So JEPQ, NASDAQ 100, large cap companies. JEPI follows S&P with the programmed point to run a low volatility, high income monthly ETF based on dividends and affordability. They're both in around $53, $54 range per share at the moment. And so that's the difference. So orange, JEPI, less volatility, less opportunities to DCA into dips, slightly less interest rate. But as you can see, it does have a nice gain in the last 5 years. A bit unfair because JEPQ didn't even start, its entry until 2022, where this goes all the way back to 2020 in the 5-year mark. So this chart is a bit unfair in the percentage points. If I could do a 3-year, you'd see it much nicer. You obviously could do a 1 year and see how that return looks. Very, very, very similar. So, but as you can see there, much more wild swings with JEPQ. But if you are one that has more capital and wants to save that capital in something like QQQI or T-bill or one of those CLOA, some of those higher yield accounts, and then uh, DCA, sell those off in DCA into these dips on JEPQ, hey, there you go. So you'll actually get a better return than the 8.9 if you were to DCA in those dips versus JEP high. All right, that's the 5 ETFs that I think would create a really nice, solid base long-term portfolio. Go back to this one real quick. Here's your 5-year, 136% with FDVV. We did take out VIG just because of price point. We'll put that back in real fast. Whoops, not that one. VIG. There we go. So VIG is the green down here. So, you pick your poison, right? See which one you want to look at. And like I said, we have anywhere from VIG at 1.7% all the way up to 3.3 with this FDVV, HDV 3.3. FDVV is definitely more affordable at $53. SPY-D is 5% at $44. That one's quite nice. But like you see here, 105% in the last 5 years. Come on now. Especially if you were to DCA in those dips, obviously you get a better return faster in value than the 105%. This is just tracking its own value across not personal portfolios, obviously. Then you have JEPQ, JEPI, and that's going to be a personal opinion. I know JEPQ is paying around 50 cents a share for their dividends monthly, and JEPI is a bit lower, but like I said, and you can see, you can have more potentials to get a better gain because there's less volatility. All right, that's it. That's the 5. Let me know in the comments. Join us over the Discord. The link is in the bio. It's also in this description of the video. I thank you for watching, and I appreciate the views, even though I've got a different situation going on back. I'm not in my office studio, but I thank you for stopping by. Come over to the Discord, check us out, and you won't be disappointed. I appreciate it.